Let's do another example of lease accounting from the perspective of the lessee under IFRS 16. But in this example, let's assume there's an unguaranteed residual value. That means that the lessee has made no promises to the lessor about what the fair value of this asset is going to be at the end of the lease term. So for example, if the lessor was thinking the asset is going to be worth $20,000, but then at the end of the lease it's only worth $6,000, the lessor can't come after the lessee and say, hey, wait a minute, the fair value was less than what I was expecting. I want you to compensate me for the difference. So that means that the lessee is not going to be required to make any kind of final payment to compensate the lessor if the residual value turns out to be really low. Okay, so we're also going to assume that the lessor's implicit interest rate is unknown. And that's important because that's going to affect how we calculate the present value, what discount rate we use. Okay, so let's get to the facts of the lease here. So we're going to assume that the lease begins January 1st, 2022. The first payment is also made that day. It's a 3-year lease. Okay, the lessor's implicit interest rate is unknown to the lessee, and so we can't use that as the discount rate. What are we going to use instead? The lessee's incremental borrowing rate, which in this example is 6%. So we're going to use 6% for all the discounting related to the present value calculations. Okay, what is the incremental borrowing rate? That's just a rate that's saying, look, if the lessee were to go out and borrow money to try and buy this asset, they would get an interest rate of 6%. Okay, so 6% is what we're going to use for all our discounting. Now, we've got $100,000 a year payments. We've got 3 of them, and they're made at the beginning of the year. So the first payment is on January 1st, 2022. So to calculate the present value of these $300,000 payments, we take $100,000, we multiply it by 2.83339. Okay, and this is the present value of an annuity due. Okay, for 3 periods at a rate of 6%. So basically, this is a present value of $1 annuity due, 3 periods, 6%. That's where I got this number from. And you multiply that number by 100,000, which is the amount of our annual payment, comes out to $283,339. So this is the initial lease liability. We're assuming there's no bargain purchase option. There's nothing like that. There's not going to be a final payment related to the residual value because the residual value is unguaranteed. So we've just got this initial lease liability of $283,339. Okay, and here is our lease amortization table. And you see $283,339. That is our initial measurement of the lease liability. So the lessee, this is the amount they're going to put in the liability section on their statement of financial position at the commencement of the lease. Okay. Now, over time, they're going to make payments, and the payments are going to reduce the lease liability. And day 1 of the lease, they make the first payment. So the lease liability immediately goes down by $100,000, and it's $183,339. And we're going to multiply that amount by 6%. And that's going to give us the interest expense for year 1 of the lease. Okay. So this times this equals this, $11,000 of interest expense. So this is going to go on the income statement, okay, and reduce the profitability of the lessee. There's also going to be depreciation expense of the right of use asset. We'll get to that in a moment, though. Let me just finish. So we have another payment here, $100,000. Lease liability goes down again. And then for the second year, multiply that by 6% again. This times this equals the interest expense, $5,660 for year 2. Now, for year 3, there is no interest expense because the final payment, the final lease payment, is made on day 1 of year 3 of the lease. So basically the lease liability has gone to 0. So then there is no interest on the lease liability because it's at 0 as of the beginning of the third year. So that's why, if you're wondering, why do we only recognize interest twice? That's why. So let's get to our journal entries. And also remember, I had said that there's always going to be a right of use asset recorded on the statement of financial position when the lease liability is recorded. Okay, that's what happens when you capitalize a lease. Now, how did we calculate this right of use asset? Well, you always calculate it, but you start with the initial measurement of lease liability, and then you make adjustments. For example, if there were prepayments made prior to commencement of the lease, if there were incentives received from the lessor, we're going to assume there's none of those here. We'll keep it simple. So the initial right of use asset, $283,339, is the same as a lease liability. Okay, sometimes it works out like that in real life. Sometimes it doesn't. In this example, it does. Okay. Now, our first payment, we reduce the lease liability, reduce our cash account. Now, this amount here, we're going to depreciate over time. I'm assuming we're going to use straight line depreciation method. So we're going to take this and divide it by 3 because there's 3 periods in a lease term. Divide this by 3, and you get 94,446. So that's the amount of depreciation expense we're going to recognize. So for the first year of this lease, the lessee will recognize, in terms of its income statement, $11,000 of interest expense, $94,446 of depreciation. If you add these two numbers together, that's the total amount of expenses that the lessee will recognize in year 1 of the lease related to this lease. Now, when the second lease payment is made, you reduce the lease liability again. The liability is getting smaller and smaller as the lessee makes payments to the lessor, because they're saying, hey, I owe you less money. I've paid you some of the lease liability that I owe you, right? I owed you payments. I gave you $100,000. Lease liability goes down, but cash account also goes down. Record more interest expense. I showed you how to calculate that in the table up here. We had our lease liability. Okay, and then we multiply that by our discount rate, which in this example was the lessee's incremental borrowing rate, because we didn't know the lessor's implicit interest rate. And then because we're using straight line depreciation expense, 94,446 each time. Now, third payment, reduced lease liability, it now goes to 0. Cash account goes down, but we still have to record depreciation expense for that third year of the right of use asset, 94,446, but again, we do not have any interest expense for that third year of the lease because we paid off the lease, right? We made that final lease payment on day 1 of the third year. So we had no lease liability, so we couldn't incur any interest on the lease liability.